Take Amazon. It went 6 full years without turning a profit. Shareholders called it a disaster. Analysts predicted it wouldn't survive. Today, it's worth over $2 trillion. There's a pattern buried in the history of nearly every company that actually lasts, and it runs opposite to the advice you hear in most business content. The companies that grow fastest in their early years rarely end up at the top a decade later. The ones that survive almost always grow slower, build deeper, and frustrate everyone who wants immediate results. This isn't motivational fluff. It's a pattern that appears across industries, retail, manufacturing, technology. Once you see it, it becomes impossible to ignore. In 1997, 2 years after Amazon launched, Jeff Bezos wrote his first letter to shareholders. Most CEOs use that letter to announce profits, celebrate growth, and reassure investors. Bezos did the opposite. He warned them that profits weren't the point. Anyone expecting them had misunderstood what Amazon was building. Amazon started in 1995 as an online bookstore. It sold $12,000 worth of books in its first week. Impressive for a startup, but almost meaningless compared to Barnes & Noble, which was doing $2 billion a year. Amazon wasn't competing on size. It was competing on a different timeline entirely. Bezos never hid it. He told investors directly, Amazon didn't expect to turn a profit for 4 or 5 years. The plan was to reinvest every dollar into infrastructure, logistics, and expansion. No dividends, no short-term returns. Just compounding. Shareholders complained. Analysts warned the model was unsustainable. During the dot-com crash of 2000-2001, dozens of companies that had grown far faster than Amazon, with bigger marketing budgets, more press coverage, more investor enthusiasm, collapsed entirely. Amazon survived. In the fourth quarter of 2001, it posted its first profit, $5 million on over $1 billion in revenue. Margin was razor thin, but the point was made. Amazon Web Services, now the most profitable division in the company's history, didn't launch until 2006, 11 years after Amazon was founded. Bezos called it planting seeds and told investors to think in 5 to 7 year timeframes, not quarters. When CEO Andy Jassy described Bezos' approach, he landed on 4 words: strategically patient, tactically impatient. Big picture, long game, execution. Right now, the company that Wall Street said was growing too slowly became one of the most valuable businesses in human history. The ones that grew faster in those early years? Mostly gone. Toyota tells a similar story from another angle. For decades, it was the gold standard in manufacturing. Not just for building good cars, but for inventing an entire philosophy, the Toyota Production System. Or TPS, the core idea: eliminate waste, improve constantly, never ship a defect. Kaizen, as it's called in Japanese, meant any worker could stop the line if they saw a problem. Quality came before speed. Always, for decades, this made Toyota nearly unstoppable. While American competitors raced each other on volume, Toyota quietly built infrastructure to produce better cars more efficiently than anyone else. It was slower. It was also almost unbeatable. Then, in the early 2000s, Toyota decided it wanted to be the #1 automaker by sales volume, not by quality. The company opened plants globally at a pace its systems and culture couldn't absorb. Suppliers multiplied. Oversight thinned. Engineers and managers who embodied TPS couldn't physically be everywhere. By 2009-2010, Toyota recalled nearly 9 million vehicles for uncontrolled acceleration issues. The company that had built its identity on quality was explaining in Congress why its cars were killing people. CEO Aki Toyoda admitted publicly, Toyota had grown too fast. Consultants said bluntly, the company lost sight of the key values that gave it its reputation. Toyota recovered, but it took years and cost billions. 50 years of patient building, nearly collapsed in a decade of chasing growth. The late 1990s were the ultimate stress test for the grow fast philosophy. Hundreds of companies raised enormous amounts of money, scaled at breathtaking speed, and became household names almost overnight. Most of them were dead within 5 years. The survivors had one thing in common: They built a foundation before they scaled. During the internet gold rush of 1995 to 2000, startups that had existed for 18 months were valued at billions. Marketing budgets were limitless. Customer acquisition was everything. Profitability was considered quaint. Pets.com raised $82 million, ran a Super Bowl ad, and went bankrupt 9 months later. Webvan raised $375 million to build a grocery delivery network and collapsed before the economics worked. Kozmo.com promised 1-hour delivery of anything and burned through $280 million before shutting down. Google, by contrast, wasn't the fastest growing company. Yahoo was larger, better known, and better funded. But Google obsessed over making search work better. Advertising infrastructure followed methodically. When the dot-com crash cleared the field, Google was still standing and accelerating. Amazon did the same, not fastest, most deliberate. The companies that died optimized for metrics that looked impressive to investors but didn't reflect whether the business actually worked. Customer acquisition cost over lifetime value, revenue over margin, headcount over output per person. The crash didn't kill bad ideas. It killed good ideas scaled before they were ready. The pressure to grow fast is real. Investors need returns. Competitors move, markets can close. But speed that consumes infrastructure is dangerous. Founders who survive understand the difference. Speed that compounds versus speed that consumes. Bezos called it strategically patient. In practice, it means reinvesting profits, watching competitors shine, resisting the urge to match pace, building what matters in year 10 before fully capturing year 3. Toyota's failure shows the flip side. Slow growth wasn't just a strategy. It was the mechanism that made quality possible. Chase the wrong metric and the foundation cracks. Amazon, Toyota, Google. Different industries, different eras. One pattern: the companies still standing didn't move fastest. They built something the growth couldn't break. The ones that tried to borrow tomorrow's scale today almost always paid for it. This isn't an argument for being slow. It's an argument for being deliberate about what you optimize for, because what you optimize for in year 1 determines what you're capable of in year 10. Amazon optimized for infrastructure and trust. Toyota optimized for quality. Google optimized for search, not size. When scale came, it came on foundations strong enough to hold it. As Bezos put it, all overnight success takes about 10 years, not modesty. Math. The pattern is clear. Growth that outpaces the foundation always ends the same way. The companies that survived, the ones we celebrate today, didn't chase fast metrics. They built systems that could grow without breaking. Patiently, deliberately, with a long horizon in mind. If this changed how you think about growth, hit like. It helps reach people who need to hear it. Subscribe for more videos that cut to the patterns beneath the story. And if you know a founder or business owner being pushed to scale faster than feels right, send this to them. Sometimes the best proof is that slowing down is the right move,